Yeah. Good morning, everyone. So this is your live session of intermediate direct tax classes, income tax law. It is paper 4A. What we'll be discussing today is clubbing of income. So when you say clubbing of income, so we are trying to say that the income is actually of some other person and it is being linked to another person. So typically, we'll take an example. So there is a family, right? A typical family in a nation is basically there is a earning member and you have a dependent spouse and probably let's say a couple of kids. So these are the structure of a typical family. Now in income tax act, in the Indian tax laws, what is recommended or what is prescribed as far as the tax slab is concerned is there are slab rates. That is, for the first 2.5 lakhs there is no tax rate, and then you have 5%, 10, 20, and then you have 30%. So these are the tax slabs as far as the Indian income tax law is concerned. So let's assume a male member, let's say is earning around 15 lakhs. So which means is already taxable at 30%. Now, rather than having, let's say his income was 9 lakhs, which means he'll only be taxable at 20%. Now, the balance 6 lakh, if he's trying to push it to someone else whom he has control of, So if that relationship exists and he's able to transfer the income and still enjoy the benefit, what happens? What happens is the 6 lakhs will be taxable at a much lower rate and the 9 lakhs will be taxable at 20%. So he's avoiding the 30% tax slab. So this is what is typically a clubbing is all about. So there will be a male member. This is a typical example, which is in the highest tax slab, that he is in the 30% tax slab. He is transferring his income or the property to spouse, so that the income is going to be earned by someone within the family. So he will still be able to enjoy the benefit, but he will not be paying the taxes. So he's evading the taxes on that particular proportion. So this rental income of spouse, whatever that, if say he's transferring the property, the rental income of that spouse will be earned by the spouse, but it is just for the sake of transferring the tax, so evading the tax. So for this reason, income tax has introduced this concept of clubbing of income. That is, an income of someone will be clubbed in the hands of the someone else, that is the assessee. So this is what we are going to see about in the first half of the session. So basically, as we said, if not, that income would have been taxed at 30%. Just for the sake of reducing the taxes, the income is transferred to another person, so that it is divided. The tax is distributed at a lower rate, so the tax is basically evaded. So there is, what do you mean by this? There is intentional transfer. Whatever we are calling here is intentional transfer to reduce taxes. So clubbing of income or provisions introduced by Income Tax Act is available in Income Tax Act purely for the purpose of reducing tax liability on intentional transfers. So for such transfers, this concept of clubbing of income comes into the picture. So as far as the session goes, I'll stop once in a while to just go through your queries and just respond to it. Till then, I'll just keep continuing. So I'll stop at a particular point in time and go through your queries and answer it. So we'll move on to the provision. So we said this clubbing of income, whatever we'll be discussing in this particular session, basically this chapter is discussed from section 60 to section 64. So these are the sections that we'll be going through to understand in what circumstances clubbing of income comes out. So if you actually see the first one, that is section 60, says clubbing of income in a case where there is transfer of income, but the asset is not transferred. What is that? We'll just hold on for a couple of minutes so that we understand that in detail in the subsequent slides. So similarly, the second one is section 61, which talks about revocable transfer. Here, we are talking about you might be transferring to anyone, but still you have control of such property or income. So that is called revocable transfer. Again, as I told you, we'll hold on for a couple of minutes so that we see each one of them in detail. Third one is, there are situations where spouse income is clubbed in the hands of the other spouse, the partner. So if you actually see this clubbing, this introduction, whatever we have discussed here, is where we are saying that spouse income is clubbed in the hands of the husband. So this is what is called as spouse income. So that is discussed in section 64, subsection 1. And then you have income of son's wife. That is basically the daughter-in-law So the father-in-law or mother-in-law transferring certain property or income to son's wife just to avoid these taxes. So that is also covered in 64(1). And then you have finally minor's income. That is minor's income. So let's say you are transferring some of the fixed deposits in the name of the minor. So such minor's income will also be clubbed in the hands of the parent. So that's what we are going to see in this particular session. So this is all about clubbing. So we'll start with the first section, that is section 60. So in section 60, if you actually look at it, there is clubbing of transfer of income without transfer of asset. So when you say without transfer of asset, what do you exactly mean? So let's take an example. So there is a person, we'll call him as transferor. Of course, the one who's transferring is transferor. So what is he transferring? He's transferring a house property. He's transferring an asset, which is an house property. Now this asset is being let out to a tenant, okay, a family. So it's being let out to a tenant. Now this tenant, to whom should they actually pay the rental? They'll have to pay the transferor. They'll have to pay it to the transferor. But here, what they're actually doing is they're paying it to the transferee. So which is the spouse of the transferor. So this transferee here is actually not the owner of the asset, is actually not the owner of asset, but still enjoying the rental benefits, right? So this concept is called transferring the income without transfer of asset. So what does this section says? So when does this section say that this provision is applicable? It first says there must be an asset. So there must be an asset. It must be owned by a person. That is, it must be owned by a person. So when you say owned by a person, they are trying to refer someone who's not the assessee. So we are saying not assessee. So typically the income earned by transferee, she is the assessee, right? So it must be taxed in her hand. So she is the assessee, but it is actually owned by a person who's not the assessee. That is the transferor. So it is owned by a person, and the income alone is transferred. Income alone is transferred to the. So when I say income, as I told you, it is income alone. So not the asset, just the income is alone transferred to another person. So in this case, it was transferee here, right? So this income to other person is taxed, will be included in the total income of the transferor. So this is where clubbing comes into the picture. Basically, you're trying to say, see, the asset is yours. Income should also be yours. So pure reason why you are transferring this income is typically to evade taxes, it's an intentional transfer of income to evade taxes, to reduce taxes. So this is actually should be taxable only in the hands of you, in the hands of the owner of the asset. So that's why we said it is included in the total income of the transferor. As we said income is alone transferred. We are trying to use a word that it can be revocable or irrevocable. So what is revocable, irrevocable? We'll see it in the immediate next slide. So as of now, we'll just understand it doesn't matter what kind of transfer it is, whether it is revocable or irrevocable, whatever kind of transfer it is, if an asset is not transferred, but the income alone is transferred, such income will be clubbed in the hands of the transferor. What actually is the word transfer? Section 63. When I say section 63, I want to just give you a background. There are always a section which talks about definition. For example, the whole Income Tax Act. Section 2 talks about definition. So section 2 says definition of various particular provisions. Now, each of the chapter or most of the chapters will probably have an independent section for its definitions for that chapter alone. Sometimes let's take this profit and gains of business or profession. You have section 43, which talks about the relevant terms for profit and gains of business or profession. So similarly, there will be so many chapters which has an independent section or a clause which provides you the definition of relevant terms for that chapter. So in this chapter, section 63 is the definition section. So it provides definition for some of the key terms. So 63 clause B provides definition of the word transfer. So we are saying you need to transfer the income. So to know that an income is transferred, we must first know what is transfer. In general term, we know that it is the rental, as we said, is being paid to them. That is, it is received into the bank account of the transferee. So that is a transfer. So to give a legal definition to this, they have just defined transfer as it includes any settlement, trust, covenant, agreement, or arrangement. So whatever you're talking about, it could be for the purpose of settlement or in a form of trust or something, or in form of an agreement or arrangement. It could be in any structure. But if the right, so the typical thing, what happens in a transfer is the right is given to another person. The right of enjoying the income, the right of receiving is given to another person. So that is what is actually called as transfer. So transfer includes any settlement, trust, covenant, agreement, or arrangement. So these are all what you call it as transfer. So now we'll just see a typical example. So there is one person, Mr. Watson. He has transferred through a duly registered document. So there is a document registered which says income arising from the godown to son will actually be the income alone will be transferred to the son without transferring the godown. So this is what is happening. Watson is owning the property and rent is being provided to the son. So in whatever we saw in the earlier slide, what should happen right now? The income, should it be taxable in the hands of the son or in the hands of Watson? Son here is what? Son here is transferee. And Watson is transferor. So what should typically happen? It should be clubbed with Watson's income. So whatever is happening, the income should be clubbed with Watson's income. So this section, we have to provide a reason. So we are trying to say section 60 expressly states where there is a transfer of income of an asset without transferring the asset itself, such income shall be clubbed in the hands of total income of the transferor. So hence, the rental income of received by the son of that godown shall be clubbed in the hands of the transferor, that is Mr. Watson. So that's what is the solution. So this is about the clubbing of transfer of income without transferring the asset. So that's what you're actually calling it as transfer of income without transferring of asset. So now the next part that we were talking about. So next part is basically we were talking about this transfer of income. So transfer of an asset. So what we are trying to say here is transfer of an asset. So when you say transfer of an asset, we are trying to say you are actually transferring the asset, but also the income. So in the first case, we saw that it was only transfer of income alone, but here we are trying to say the asset itself is transferred. So that's what we are trying to understand here. So in this particular situation, whatever we'll understand is section 61 talks about this transfer. What does section 61 says? It says by virtue of revocable transfer. So it says any income arising to any person by virtue of revocable transfer of assets is to be included in the total income of the transferor. So we need to understand what should be taxable in the hands of transfer. So what do you mean by revocable transfer? So for this, we need to understand what exactly is revocable transfer. So the section 63. So what is section 63? 63 is a definition section. So 63 clause A provides what is revocable transfer. What is revocable transfer? When you say revocable transfer, it is basically there is some kind of retransfer, that is, in simple terms, we'll first put it across in this manner. At any point in time in the life of that arrangement, if the other person, that is the transferor, has the power to get back the rights, So in such case, it will be treated as revocable transfer. That's what they're trying to say. It contains any provision for retransfer. So it can come back to whatever asset that has been transferred to another person can come back to the owner itself. There will be a provision in that agreement. It could be the whole asset or any part of the asset alone. So if there is some clause which provides that the asset can be taken back by the transferor, either in whole or in part, then it shall be called as revocable transfer. So in some way, either the asset should be transferred or is at least reassuming the power. Though the asset is actually not transferred, he can still assume power. He can still assume power, which means he has control on that property. He only decides everything on that property. So if he has, if there is a clause which says there is a right to reassume power directly or indirectly or the whole or any part of the income or associate. So we'll have to remember two words. So the power could be relating to retransferring, that is retransferring the whole asset. Otherwise, it could also be relating to reassuming the power. Just give me a second. Sorry. So there could be either retransferring the asset or reassuming the power. So remember the two things. One is you have this retransfer. Other is you have, I'm sorry, just give me. Sorry. So one is retransferring the asset, another is reassuming the power. So these are the two things that is actually contained in this concept of revocable transfer. So let me repeat. One, the first point is the asset in some way or other could be retransferred directly or indirectly, either in whole or part, back to the transferor. So that is the first thing to be called as revocable transfer. The second thing is, in some way or other, he has the capacity to reassume, take back the power, the influence that he has on that property. If he has that whole or any part of the income, so then also that will be called as the revocable transfer. So this is revocable transfer. So what the provision 61 says is, it says, if it is a revocable transfer, if the transfer is actually a revocable transfer, then in that case, the income from that asset will be clubbed in the hands of the transferor. So in the previous slide, we saw only the income is transferred. Now we are trying to understand both the income and the asset is transferred. Next you have, when we say revocable, we always have to understand the term irrevocable also, because only then we'll know what is not an asset that has to be clubbed. So for that, we need to understand what is irrevocable, because we have now understood what is revocable. We need to understand what is irrevocable. What is actually irrevocable? We can probably simply say anything which is not revocable, is irrevocable. But still, there is a definition for it. So section 62 provides, by way of trust. So let's say there is an arrangement. In that arrangement, it is not revocable during the lifetime of the beneficiary. So that is a clause here. So during the lifetime of the beneficiary, and in the case of any other transfer, during the lifetime of the transferee. So in case of trust, it is beneficiary. For everyone else, it is transferee. Both are same person. So we are calling the beneficiary and the transferee as the same person. That is the one to whom the asset is actually transferred. But what is being said is, if it is a trust, you call them beneficiary. In any other case, you call them a transferee. So here, in case if it is actually through a trust, when you say trust, it is a person. So trust itself is a person. So if it is through a trust, then lifetime of the beneficiary. If it is in any other case, that is, let's say, for between relationship, husband, spouse, father, son. So if it is between relationship or between, even if relationship is not existing, it is fine. So between in any other case, what we are trying to say is it's lifetime of the transferee. So that is the reason. So probably you can remember just one term, transferee. In trust, they are called as beneficiary. That's the only difference. So in trust, it is in lifetime of beneficiary. In any other case, it is lifetime of the transferee. Just for the sake of theoretical purposes, there was an act before Income Tax Act 1961. So if there is any transfer which is made before 1961, in that case, the period was there 6 years. So if there is an agreement for a period of more than 6 years, then it was considered to be irrevocable. So that was an earlier provision. That is anything which has been made before 1st October, that is 1st April 1961. That is before the Income Tax Act. It was called so. Now, there it was said 6 years. But whatever we need to remember right now is only this part where we say it is irrevocable if that it is not revocable during the lifetime of the beneficiary. In any other case, it is during the lifetime of the transferee. Clear? So this is where you call something as revocable or irrevocable transfer. Sometimes what happens is the transfer will be for the purpose of benefit. That is, section 62 says, yes, it is irrevocable. Yes, it is irrevocable, but there is some form of benefit always coming back to the transferor. Some form of benefit always coming back to the transferor. Let's say the income is actually 10,000. You say, you take 8, you give me 2,000. So this is transferor, this is transferee. Okay. So you say, yes, it is irrevocable, but you always say, you keep 8,000, give me 2,000. So give me 20% of income you're receiving from the asset. So if there is such clause available in the agreement, even though it is irrevocable, it will be called as revocable. Even though it is irrevocable, it will be called as revocable. So the transfer receives direct or indirect benefit. So that's what we are calling. So this is called benefit. So you are getting a portion of it. Such income shall be included in the income of the transfer, even though the transfer is irrevocable. So in this case, even if it is irrevocable, it still has to be clubbed. So that is what you're actually calling as revocable and irrevocable. So I'll just go through some of the questions to understand, to just answer. So what do you mean by covenant? Covenant is typically basically it's an agreement only. It's an agreement only. It's a legal form of agreement. So it is nothing but an agreement. So that's why I did not stress on that word. So when you say settlement, trust, agreement, arrangement, everything has its own meaning. Covenant itself is also a kind of agreement only. And yeah. In case of revocation, the ownership is with whom? You're actually calling as transfer of asset only. So basically the asset itself will be transferred in the name of the transferee. So let's take a property, an house property owned by, let's say, Mr. Rahul. Rahul transfer this property, that is transfer. When you say transfer, they transfer the ownership. I'm very sorry for my handwriting. I'm very poor at it. So when you say transfer, you're actually calling it as transfer of ownership to a particular person. Let's say someone, son of Rahul, let's say is whatever name you want to call, I'll just name it Ashok. So now it is being transferred to this person. Now this person is the legal owner, though the reason of the transfer is not for legitimate transfer. The reason began, the intention behind the transfer is to transfer the income also. So you're not only transferring the income, you're also transferring the asset and the income. So in this case, it will be clubbed in the hands of Mr. Rahul. So that's why you call it as the transfer. So when you say revocable transfer, it is transferred at any point in time. Let's say you actually have a right to get back the property. So that is what is there. So if it is irrevocable, it is completely transferring. The Rahul will have no rights on that property for the rest of the period. That's why we said lifetime of the transferee or the beneficiary. So that is what is called as revocable transfer or irrevocable transfer. So the transfer is actually transferring the asset itself. So that is about revocable transfer. Okay, we'll move on to the next category. Okay, I'll just have one more question. What is reassuming power? So when you say what is reassuming power, Karthik, when you say reassuming power, you have the you have control. Let's say you have control on the property. Let's say you decide who the tenant has to be. You decide what the rental has to be. So if that power, so that is what you call by power. You take the decisions because of that property. So that's what you call it as reassuming power. And Namrata, whether 2,000 will be clubbed or the 10,000, the whole income, because the 2,000 already received in the example that we were talking about. This 2,000 is already taxed in transfer only. This 8,000 only will be clubbed here. That is, in total, the entire 10,000 will be taxable in the hands of the transferor. So that's what is there. Gift of a son, yeah, you can give it as a gift, but the gift is supposed to be for the intentional transfer of income. Then it will be taxed. So the purpose in clubbing is purely about the intention of transfer. It is not about whether you can transfer or not transfer. It is only about the intention behind transfer. If it is proved that the intention is purely for the tax evasion or reducing taxes, then it will be called as clubbing. So irrespective of whether it is a gift or whatever it is. So we are not bothered about whether it is gift or not. If it is transferred for a purpose of transferring the income so that taxes are reduced, it will be clubbed. So that is about thing. So we'll move on to the next section. Income arising to a spouse. So we are just taking an example. There is Rahul and you have Pooja, spouse. Now, Rahul has substantial interest in ARC Private Limited. What is substantial interest? For time being, we'll understand this just one word. It is 20%. We'll just keep this word. In the next slide, we'll understand the definition of substantial interest. So, Rahul has substantial interest in ARC Private Limited. Okay. Now, this company, the ARC Private Limited, is employing a finance manager. Whom are they employing? They are employing Pooja Rahul. So they are employing this person in ARC Private Limited. So now we are not sure. Let's assume there is no educational qualification of Pooja. So in this case, since there is an employment there, whatever the income of Pooja, whatever is the income of Pooja, when you say income, you are meaning the salary income. You are referring to the salary income. That salary income will be clubbed in the hands of the Mr. Rahul. So this is what is clubbing of income. When we are talking about this employment, we said about the educational qualification, right? Educational qualification. Let's assume Pooja is a CA. So she is a chartered accountant. Now, is she eligible to be a finance manager or not? Very much, right? So all of us here will be chartered accountants or eligible to be a finance manager in a particular organization. So now she has been employed for based on her educational qualification, In that case, this provision does not apply. So what the 64 subsection 1 says is basically, if a spouse of a person who has substantial interest is employed in that particular company, then the income has to be clubbed in the hands of the person who is owning the substantial interest. So that is the provision. But the provision also says, if that employment, whatever is of that spouse, is because of the educational qualification, then this provision will not applicable. So as the provision says, she possesses technical or professional qualification. Then, so here she is a chartered accountant, so which means she has that skill. So automatically she becomes eligible to be appointed as a finance manager. So need not club of income. So understand the logic. Yes, a person has a substantial interest. Now in that particular company, the spouse is employed. When the spouse does not have the relevant educational qualification, then the income will be clubbed in the hands of the transferor, that is in the hands of the person who is owning the substantial interest. If she possesses educational qualification, then it is not clubbing. We might have known many cases where both the spouses work in the same organization. So it doesn't matter. Both of them would have had the educational qualification to work in that particular organization. So typically the provision is only for situations where there is no sufficient education qualification, but still recruited as an employee. So that's what you're calling by section 64. In computing total income, the income that is arising to the spouse of such individual by way of salary, commission, fee, or any other form, whether in cash or in kind, such individual who has a substantial interest. So that's the provision all about. So when you say this provision, we are only talking about of an individual having a substantial interest in that entity, in that organization. In that organization, the spouse is appointed and she is receiving salary, commission, or fee, or whatever in the manner that you can call. So it could be in cash also, it could be in kind also. So here the income is clubbed. We need to understand what is substantial interest. What is substantial interest? If it is a company, it is equity carrying 20% or more in the previous year. When you say equity, it is not only the self, it will also include the relatives at any time during the previous year. So when you say on 30th May, you had 30%. At the end of the year, you have actually sold off, it is still applicable because at any time of the year, you have had 30%. So when you say substantial interest, it can be at any time during the year. What do you mean by other cases? That is other than companies, for other entities, it is a profit sharing ratio. If it's a partnership firm or any of thing, it's a profit sharing ratio. If the particular person is eligible for 20% or more of profits, then it shall be called as thing. And whenever you're calling the percentage, it is not only of that person, it includes the relatives. Relative is what you would have already studied in income from other sources. So that only is called as relative definition. So there is a question. Now, what if in this case, in our example, let's say Rahul also has 25%, Pooja also has 25%. Now, let's take what happens. So what happens in that particular case? So in that particular situation, what they're saying is, they're saying when both of them have substantial interest and both are receipt. So not just Pooja Rahul alone, both Pooja Rahul and Rahul are appointed. Such income will be includable in the hands of the spouse whose total income excluding this is higher. So we have to compare both the incomes, whosoever income is the higher. Before including this income, we'll have to compare the other incomes of that particular person, both the person who's holding substantial interest, whosoever is higher. In that person's income, it has to be clubbed. So that is what they're saying when both have substantial interest and when both does not have educational qualification. Please remember this word. The provision does not apply when there is educational qualification, that is technical or professional qualification is there for that particular profile. This provision is not at all applicable. So we're only talking about situations where there is no professional or technical qualification for that particular employment. So we'll see an example. So A holds shares carrying 25% in X Limited. Mrs. A is working as a computer software programmer at a salary of 30,000 per month. She is, however, not qualified for the job. See the word, not qualified for the job. So the other income of Mr. A is 7 lakhs, Mrs. A is 4 lakhs. Now we need to compute the gross total income for the assessment year 2022-23. So we'll just try to work out this as a formula. So basically, we'll have to compute. Let's keep particulars. We need to calculate for Mr. A and Mrs. A. Okay. So we'll start with each one. And when I say clubbing, one thing I forgot to tell you is whatever income we are talking about will be clubbed as the same head. If you're talking about salary, it will be taxable as salary in the heads of transferor. If it's income from other sources, it will be income from other sources in the hands of the transferor. So the heads will not change. So that's one thing that I wanted to tell you. So we'll take the other income. So we have not given what it is. So we'll take 7 lakhs as in the hands of Mr. A. And for Mrs. A, it is 4 lakhs. And then we'll have to see what is the salary income. So salary income is 30,000 per month. 30,000 per month. So when you say 30,000 per month, it is basically, since there is no educational qualification, it has to be clubbed in the hands of Mr. A. So we'll have to take, I'll just write it here. It is 3,60,000. I will write it here itself. It is 3,60,000. Being salary, they only given you a monthly salary, right? Assuming that the entire amount is taxable. When you say salary, what comes to your mind? Whenever it comes to salary, you will have to provide deduction, standard deduction. Standard deduction under section 16. So 16 says, provide 50,000 standard deduction. So the income from salary will be, 3,10,000. So this will be the income from salary. The total income will be what? 10 lakh. 10,10,000, correct? For the Mr. A, it will be 10,10,000. For Mrs. A, it will be 4 lakhs. Now, what does the question says? It says, will your answer be different? Will your answer be different if Mrs. A was qualified for the job? What happens? Very simple. We said the provision is not at all applicable. So automatically, Mr. A will be 7,10,000. Sorry, 7 lakhs will be 7 lakhs. There is only this will be taxable. And in case of Mrs. A, it will be 7,10,000. That is 4 lakhs plus 3,10,000 of salary income. So this is other income. This is salary income. So this will be Mrs. A's income, whereas Mr. A income will be only 7 lakhs. That is the other income. So that is how you do this formula. This question. So this question is basically about clubbing of income, where what happens when there is qualification, what happens when there is no qualification. We'll see another question also. Mr. B holds shares carrying of 30% voting power in Y Limited. Mr. B is working as accountant and getting an income 3,44,000 without any qualification in accountancy. Mr. B also receives 30,000 as interest on securities. Mrs. B owns an house property which she has let out. Rent received from tenant is 6,000 per month. Again, this is also a similar problem. Just that instead of A, we are going to compute it for Mr. B. So we'll start with the question. So we'll start with the next question. So it's basically, again, you'll have to do the same thing. Particulars. You take Mr. B. We'll first compute for Mr. B alone. So what is Mr. B's income? Mr. B was working as and without any qualification receives 30,000 as interest on securities. So Mr. B is receiving interest on securities and the salary income. So when you say salary income, they are saying that computed. See the word computed. When the question provides the word computed, it tries to say that standard deduction is already provided, all deductions, allowances are already provided. So you'll have to just like that take it 3,44,000, and then you have interest income, that is your income from other sources. How much is that? Interest is 30,000, receives 30,000 as interest. So the income will be 3,77,000. Now what about Mr. B? Mrs. B. So when you say Mrs. B, we'll only have to take this 6,000 per month. So she has let out for 6,000 per month. So the house property income, 6,000 into 12. 6,000 into 12 is 72,000. When you say house property income, this 72,000 is your net annual value. What do you do from net annual value? You reduce standard deduction at 30% under section 24. So what is 30% of 72,000? It will be 21. So 30% is 21,600, right? So the balance will be your income from house property. So this income that we are talking about, 72,000 into 30% is your standard deduction, and the rest will be your taxable income, right? 5,400 will be your income from house property. So Mrs. B's income will be 50,400. So now we were talking about remuneration, right? So that was discussed in 64.1.1. Now we are going to discuss about what if an asset is transferred to a spouse. We have already discussed about revocable transfer. So in revocable transfer, the ownership need not be necessarily transferred. For example, we were talking about transferring the property itself, but we are talking about reassuming the power. So the ownership might come back. So we are only talking about an agreement or arrangement. But what about the asset that is entirely transferred? An house property is entirely transferred to the spouse. What happens? Why is this transfer of asset to spouse indicated differently? It's purely for one reason. We'll just see that in this slide. So house property, if it's an house property, whatever asset we are talking about needs to be discussed under section 27. That is, section 27 says it has to be clubbed in the hands of the provider itself. But it provides that the provisions will not apply if it is for an agreement to live apart. The agreement to live apart. So if it is for the purpose of divorce, if it is for a purpose of settlement, for an agreement for a live apart, this transfer of asset will not be clubbed. So that is why it is important to understand. So section 27 in house property deals about such transfer. So if it is for the purpose of living apart, then it will not be considered as clubbing. If not, it will be considered as the transferor will be the deemed owner. Whatever we saw in the revocable transfer, the deemed owner will only be the transferor. It will be taxed in the transferor end. If it is other properties, if it is any other property, whatever transfer, it could be a direct transfer or indirect transfer, income arising from transferred asset will be taxed in the hands of transferor. So it is typically what we saw earlier only in the revocable transfer. Whatever transfer is happening to a spouse is discussed separately in this section, because it matters whether the asset is transferred for living apart. So if it is an house property, if it is transferred for living apart for the purpose of divorce, then it is not clubbing. It is not clubbing. For any other reason, whatever transfer has been made, the transferor will be supposed to be the deemed owner. For any other asset also, it's the same. The income will also be clubbed in the hands of the transferor. So that's what it is about. So the income, in case of house property and any other asset, it will be clubbed in the hands of transferor. But in house property alone, if it is for the purpose of living apart, for the purpose of divorce as a settlement, then it is not clubbing. It will not be clubbed. So that is about thing. In some of the judicial rulings, it was discussed. They said, see, I'm not actually transferring without income. The love and affection which I've received from my spouse is actually the consideration. So the question came out, whether natural love and affection, so where no money is involved, but you say, I've given in kind. What is that kind? You are saying love and affection is the kind. So this is what is the consideration that I've paid. So it is not clubbing of incomes. This has been argued in a few cases. So the courts very clearly said, the love and affection cannot be treated as an adequate consideration. Of course, right? I don't think probably you need a court to tell this, but still it has been held in the court saying that whatever you're calling as consideration is only money, is only monetary value in kind or whatever. Natural love and affection cannot be equated to adequate consideration. So this is what was held by the in this particular case. So for us to remember, natural love and affection cannot be called as adequate consideration. Sometimes what happens is the transfer of asset will not directly be to the spouse, but will be to a person or AOP, but the transfer of asset itself is for the benefit of transferor spouse. So we'll just take an example. You have Mr. A. He is transferring to, let's say, a trust, ARC trust. He is transferring a particular property. Okay, he has transferred this property. Now, the trustee in ARC is Mrs. A. So Mrs. A enjoys this property. She enjoys the benefit. She enjoys the property. She gets the benefit of that property. So whatever is happening here, the asset is actually transferred only to a trust, but it is for the benefit of Mrs. A. Transferor spouse. That's what the provision says. Transferor spouse. So the provision says if a transfer is made for the benefit of the transferor spouse, then it will be called as clubbing. So you need not transfer directly to A. You need not transfer directly to Mrs. A. You can also transfer for the purpose of benefit, for the benefit of transferor spouse. So that's what you're calling as benefit of transfer source. Even then it has to be clubbed. So that's what they're saying. So to just summarize, the asset, if it's an house property, for any other reason other than living apart, it will be clubbed in the hands of transferor, the other spouse. For any other asset, it will be, the income will also be clubbed in the hands of the transferor. And as we said, adequate consideration should be money or money's kind. It cannot be natural love and affection. And when you're talking about transfer, it need not be directly to the person. It could be to a person or an association of person for the benefit of transferor spouse. In that case, the income will be clubbed in the hands of transferor. So that's about spouse. So that's all about spouse. Now, whatever asset is provided, right? The asset is actually transferred to the spouse. But unless there is an income, it cannot be clubbed. Only the income can be clubbed. So we need to understand about the treatment of the income arising to the spouse because of such transfer. So provision says 64(1) very clearly says income accretion. When you say accretion, we'll remember the term addition, or we'll even remember the word natural addition. Okay, natural addition. So this income accretion, what the provision says is income from transferred from that asset alone must be clubbed, and you cannot club investment from such income cannot be clubbed. So again, this is also a typical judicial ruling. When you actually transfer a cow, it is a transfer. Any income from that cow, whatever income that you're receiving from that cow is basically a transfer. But the calf, so cow is a transfer, the calf is an accretion. Now, any income from this is not clubbed. If you have to understand in another sense, we'll basically assume A gives to Mrs. A an house property. Okay. Now, in this house property, Mrs. A receives rental income of 10,000 per month. Okay. In this 10,000, Mrs. A is putting a recurring deposit of 7,500 per month. She receives interest on this recurring deposit. This is accretion. So this is called accretion. So because what was gifted was only house property, the income from house property, the rental income is clubbing, but that income, if deposited into another account as fixed deposits or recurring deposits, any income from that is not clubbed because it is accretion, because it is a natural addition that has happened. I've invested in an RD, I'm getting an income. That is not clubbing. So that is what this provision says. When they talk about accretion, income arising to a spouse, they are trying to say, yes, income must be clubbed, but club only to the extent that comes from that asset, If that has been invested into another asset, don't club that. So that's what they're actually calling it as. So this is called accretion. Now, when you're talking about this investment, we said whatever investment is being made, whenever an investment is being made, we are talking about asset and all. What if the money has been given as capital? I have given money to the spouse to support the business. So directly given. So what about investments? When there is an investment made in a business, proportionate income. If there is 10 lakhs of investment, I have given 6 lakhs, spouse has contributed 4 lakhs. Now, whatever profit is related to the 6 lakhs, this must be clubbed. So, of course, we'll understand this concept, this capital concept in the next question so that we get a better idea. After this, I'll just take up some questions. Mr. Vaibhav started a proprietary business when he has started on 1st April 2020 with a capital of 5 lakhs. So he has started with 5 lakhs. In the first year, in 2021, he has made loss of 2 lakhs. To overcome the financial position, his wife, Mrs. Vaishali, she is a software engineer, gave him a gift of 5 lakhs. He has invested that money into the business. So typically the purpose of that money is to put into the business. Now this money has come into the business, that is 5 lakh has come into the business. In that year, he has made profits of 4 lakhs during the year of 21-22. Now they wanted to understand what will be the treatment of this income. Now we'll understand this problem. Vaibhav, Vaishali. Okay. So as far as Vaibhav goes, he initially invested how much? He initially invested 5 lakhs. At the end of the year, he had loss of 2 lakhs. So his capital, his money, his share of money is 3 lakh as on 31st March 21. Now Vaishali has given 5 lakhs. We'll actually keep it as 1st April 21. So Vaishali has contributed 5 lakhs in that particular year. Now in this year, that is previous year 2021, 22, profit is 4 lakhs. Profit is 4 lakhs. So this 4 lakhs is now should be clubbed in hands of both things. That is in the ratio of 3 and 5. That is 3 by 8 and 5 by 8. So this must be clubbed. This share 3 by 8 belongs to Vaibhav because as on this date he had 3 lakhs, and 5 by 8 goes to Vaishali because she has contributed 5 lakhs, and 8 is because that is the total capital. So 8 is nothing but the total capital. So totally in that previous year 21-22 they had 8 lakhs of capital, which 3 belong to Vaibhav, 5 belong to Vaishali. So in this ratio, 3 by 5 ratio, it has to be distributed. So that is what has to be the income for this particular thing. So hope any questions on this? I have answered transferee, head of taxability I have answered, substantial interest. Yeah, what is the meaning of relative? Same as what you have seen in income from other sources. Any lineal ascendant or descendant of the spouse and the self person. So that is your relative definition. Yeah, so that's the thing. What about father is deceased and subsequently the income is transferred? We will discuss that in a little later. So basically, when it is through succession, then it is not clubbing. So whatever we are talking about is intentional transfer. Intentional transfers are only discussed here. So hope you are all clear about the spouse income. So similar concept also exists for son's wife. Whatever we discussed of spouse, to a great extent, same thing relates to son's wife also. So when I say fill and mill, we are calling as father-in-law and mother-in-law just for the sake of our own slide purposes. So without adequate consideration, so you're transferring an asset without adequate consideration. So in that case, whatever happens, the transferor will be the deemed owner. Same what we discussed in spouse. When an asset is transferred without adequate consideration, it will be clubbed in the hands of the transferor only to the extent of that short coming of consideration. That is, the property is worth 50 lakhs. They have received 20 lakhs. For the 30 lakhs, it's not an adequate consideration. So to that extent, the income will be clubbed in the hands of the transferor. So only to that extent. Any investment, similar to what we saw in Vaibhav Vaishali case, spouse contributing money, Vaishali contributed money to Vaibhav. Same concept exists here. If father-in-law or mother-in-law is giving money to the daughter-in-law, any investment made by that is not will be clubbed proportionately in the hands of the fill or mill, that is father-in-law or mother-in-law. Same concept of benefit, that is you're actually not transferring directly to the daughter-in-law, you're transferring to a trust or an association of person or any other person for the benefit of daughter-in-law. So exactly same what we discussed in spouse matter. So I'm not going to take much of time in this. So as far as son's wife comes, whatever we discussed in spouse for adequate consideration applies here. Only thing that will not apply is living apart, because father-in-law and mother-in-law are not concerned about this relationship. So we are not talking about living apart. Any transfer without adequate consideration will be clubbed in the hands of transferor. Any investment, any amount given for investment will also be clubbed in the hands of transferor in that proportionate manner. And if it's transferred for the benefit of daughter-in-law to a person or AOP, then that will also be clubbed. So exactly similar to what we discussed in spouse. So I'm not going to take much time. So probably we'll have a exercise of this alone relating to this fill mill. So basically, Mrs. Kasturi transferred immovable property to ABC Company Limited. So she has transferred to a company subject to a condition that out of rental income, a sum of 36,000 per annum be utilized for the benefit of her son's wife. Now she says it should not be included because she no longer owns the property. So we'll just draw the relevance. So it is Kasturi. She has invested in, she has transferred a property to ABC Limited. Now this agreement is daughter-in-law of Kasturi. So we'll keep her name as Priya. So now this ABC Limited has to give her 36,000 per annum. So 36,000 per annum has to come to ABC Limited. So this is the arrangement. So here it is a benefit provided. So Kasturi is providing a benefit to Priya, but not directly through another entity. So this is an arrangement which will get taxed in the hands of Kasturi only. So it will be clubbed in the hands of Kasturi only because it is transferred for the benefit, whatever we saw, benefit of daughter-in-law. So if it is being transferred to a person, then it is taxed under this. So to just recap, for both spouse and fill mill deal, it applies. If there is an asset transfer, income from such asset is clubbed. Accretion need not be clubbed. So remember that as accretion need not be clubbed. When it comes to an investment, proportionate investment, we saw Vaibhav, Vaishali. So there we spoke about this proportionate investment. So that is there. And then for the benefit, we saw in the previous question where it is transferred for the benefit, then it is actually not there. The last part of this is minus income. So the minus income skill is basically, we need to understand whether it is based on their own skill. So I've just drawn a flow chart to understand this provision. So the first question is whether the income is based on the skill of the minor. If yes, it is taxable only in the hands of the minor. What do you mean by skill? Probably you have these, it could be related, let's say he's a chess champion, he's a music artist, he's earning money out of his music artist. So there are various young prodigies, right? The prodigy who start earning in a very young age itself in various reality competitions or let's say games oriented competitions. So it could be anything. So any money income is received, any income is received from such skill based activity, then it must be taxable in the hands of the minor itself. If not, we need to see whether the parents' marriage exists, whether the relationship is still in place. If yes, it has to be taxable in the hands of the parent who is having higher income, excluding this income. Exclude this income and see who has the higher income. It will be taxable in the hands of the then. If not, it will be from the partner, from the parent who's actually maintaining the child. So that's the provision about. For the sake of this, let's just understand. When I say parent with higher income, once you follow that for 1 year, with the same parent, it will be followed for the subsequent year also, unless assessing officer, AO is basically assessing officer. So the assessing officer says, no, in this particular head, it must be taxed only in your head and not under the other person's head. So unless the assessing officer comes out and says that I need to change this system, it has to continue. Once you decide in the first year whose income it is taxable, it will continue every year in the same manner. It will continue in the same manner. So that's what you say. What are the other things? This provision is not applicable for persons covered under ATU. Because ATU, we'll see that in deduction chapter. For time being, we'll understand. For a person with disability, they will be claiming deduction on their own income. So it will be for their own income. So persons covering under ATU, for such minor children, the income will not be clubbed. And clubbing provisions are also attracted in case of married minor daughter. You're not supposed to marry a minor daughter, but just for the just to keep it clear, even if they are married, it still needs to be clubbed. So for married minor daughter, the income will be clubbed even they are actually being married. And for each kid, they can claim an exemption of 1,500 per child, just been specified under section 10. This section 10 is what? Section 10 is a very detailed section which discusses about what? It discusses about exempt income. Exempt income. So it provides the income which are actually not included in the total income. So section 10 clause 32 says, if you have a minor child, for the income that you're actually paying taxes for that minor child, we will give you a deduction of 1,500. So up to 1,500 is exempt. Up to 1,500 is exempt. Only the balance is actually taxable in the hands of the parent. So that is about clubbing minors children. So 3 minor children, 2 twin daughters and 1 son. Income of the twin daughters is 2,000 per annum and 1,200 per annum. So we need to compute. I'll probably compute it. So typically, we'll talk about for the twin. So income is how much? 2,000 each. 2,000 each. So it is 2,000 into 2, 4,000 less exemption under section 1032. 2 kids. So you get an exemption of 3,000. So 1,000 needs to be clubbed. For the son, income is how much? I guess it was 1,200. So you take exemption, that is less 1032. That is also 1,200. So which is basically the point here is the provision is 1,200 or 1,500, whichever is lower. So whatever you get, the benefit is restricted to your income. So you cannot claim over and above the minor income. So maximum of 1,500 restricted to your income. So that is 1,200. So nil in this son. So total income, only this will be clubbed in the father's hand. So that's about this problem. One more question before we go on a break. Yeah, I'll just explain this alone. So salary income is 2,30,000 of Mrs. A, and then they've given each income. Probably I'll start computing directly. Particulars A and Mrs. A, Mr. A and Mrs. A. So what does it say? Salary income computed of Mrs. A, 2,30,000. Income from profession 3,90,000. Minor son 15. Minor daughter from special talent 30. Interest from 3,000. Gift received is 2,500. So we'll calculate this. So first is salary income. Mrs. A is not should be clubbed in the hands of Mr. A. So assuming it has to be clubbed, so 2,30,000. So it is computed 2,30,000. Business income is 3,90,000. Business income is 3,90,000. And then you have income of minor. Income of minor B is 15,000. So this, is in the hands of Mr. A, because it doesn't speak about substantial interest, everything. So we need not club the income. So business income is 3,90,000. Since Mr. A's income is higher, the kid's income has to be clubbed only in father's income. So minor B deposit. So that is minor deposit. Let's say minor deposit is 15,000. And then special talent. So this will not come. There is a bank receipt by C on deposit made from special talent. So we need to remember one thing, irrespective of whether it is actually a deposit required or not. That is, irrespective of whether the deposit is from her own skill income or not, it still has to be clubbed. Directly from skill alone is should be treated in the hands of the minor itself. Any other income, even if that is being deposited a fixed deposit, interest from the deposit should be clubbed only. Please remember this. What is included in minor is only directly the income from the special talent. Any additional income from deposits, other thing from that income is still clubbed. Please remember that. So this still has to be clubbed. 3,000 minor interest. So that is 3,000. And then you have gift from 2,500 is less than the taxable limit. So it is not taxable. So gift is not taxable. So the income will be, and then you'll have to less 1032, 2 kids. So you will reduce 3,000. That is 1,500 for each kid. Minus and B and minus and C. So you take 3,000. So it is basically 3,90,000. This 15,000, that is 4,05,000. 4,05,000 will be the income. Correct? So that is your income. So I'll just complete this so that with that probably we'll complete the clubbing. So then we'll continue with the break. So sometimes what happens is there is a scenario that you are actually not directly transferring to the concerned spouse or whatever, but in some way you're trying to evade tax. So we'll see an example. There's Mr. A family and his brother's family. Now Mr. A is actually transferring 1 lakh for an house property to the brother's wife. Now the brother is transferring 1 lakh for share transfer to A's wife. So what is happening is indirectly, both are trying to transferring in between, creating a network. By that, they're still evading taxes. So in this case, Mrs. B's house property income will be clubbed with Mr. B. So they will have this clubbing. And similarly, they will also have this clubbing. So Mr. B will be responsible for that 1 lakh. Mr. A will be responsible for this 1 lakh of share transfer. So whatever dividend will be clubbed with Mr. A, house property income will be clubbed with Mr. B. So this A and B are called as indirect transfer for the intention to reduce burden of taxes. So what is this exactly? Two transactions are interconnected and are parts of the same transaction. So they are only trying to evade tax. So in this case, if the intention is that, then the clubbing will be attracted. But how do you find out? It's very difficult. Only if it is scrutinized or only when reviewed, you probably identify the reason behind what this has happened. So that's what is there. Vasudevan gifted 6 lakh to his brother's wife. On 12th July 2021, his brother gifted a sum of 5 lakhs to Mr. Vasudevan's wife. So there is an interest transfer, 6 lakhs and 5 lakhs. So the gifted amounts are invested or fixed deposited by Mrs. Vasudevan and wife of Mr. Vasudevan brother at 9% interest. So this clubbing has to happen for 5 lakhs. So that is the common amount. So this 5 lakhs will be clubbed in each of the cases. So that is 5 lakhs into 9% for that period. So 1st August 2021 to 31st March 2022 for that period interest. That is August, September, October, November, December, January, February, March for 8 months. So into 8 by 12 will be clubbed in irrespective, both the persons. So it will be clubbed. So Mr. Vasudevan and the brother will be responsible for this amount, whatever amount it is, they will be responsible for that amount. So that's the consequence of this cross transfers. So with that, we'll take a small break and come back and start with this multiple choice questions of clubbing of income, and then we'll cover set off and carry forward losses. So there will be a 10-minute break. So welcome back. We'll start with the session. So basically, I'll answer some of the questions before we proceed. Um, Dubey wanted to understand illustration 5. So typically what we are trying to say is when the proportionate of capital, that profit alone will be taxable. So what we are trying to understand is the share capital. So that is, there is Vaibhav and then Vaishali, right? So on 1st April 2021, Vaibhav's income, that is Vaibhav's opening capital, is 3 lakhs. So it's 3 lakhs, which is basically, he had actually invested 5 lakhs. He has made a loss of 2 lakhs. So his current opening capital is 3 lakhs. So that's the first segment. And during this year, Vaishali has contributed 5 lakhs, right? So this is the capital proportion, that is 3 by 8 and 5 by 8. Now, what is the profit? Total profit is 4 lakhs. So in this ratio, that is in the 4 lakhs ratio, this will become taxable. So whatever is the amount, that is 4 lakhs divided by into 3 by 8, it will be 1.5 lakhs and 2.5 lakhs. So this will be the proportion of taxability. So we are saying only the proportion of profit towards that capital, that is Vaishali's capital, will alone be considered as profit sharing. So this is what we are suggesting in this 5, question number 5. And house property, basically, like as I told you, house property in case for living apart, that is, if the transfer is for the purpose of living apart for divorce or other thing, it is not club. Otherwise, it is club. So there is nothing else fresh that I need to address on house property transfer. Gift is taxable. So let's take the house property of gift is taxable. So we are not talking about the gift here. We are talking about the income from such asset. So that only has to be clubbed. So whatever we are talking about is the income generated from the asset transferred. We are not talking about the asset transferred. So gift is basically the asset transferred. We are talking about the income generated from that asset transferred. So that is what is there. As far as this minor, it is 1,500 per kid. For minor, it is 1,500 per child per annum. And no limitation on child. No limitation on child. Not like your tuition fees. No limitation on the child. So for how many ever childs you have, minor children, you get 1,500. So it doesn't matter. And for the company deposits, that in our problem, we said minor has received a special talent income. So this 32,000, is from special talent. So she herself has earned that money. And whether this 3,000 will be called as accretion is what some of you have questioned. So it is actually not accretion. So basically what we are trying to say is 32,000 is from special talent, that will not be clubbed. Any additional income from that investment or whatever could be the reason, that will be clubbed. So that's a provision. So minor income should be clubbed. Only if it is from special talent, it need not be clubbed. So what the provision says is, this 3,000 is not from your talent or skill. It is from the investment you have made. It is tax. It has to be clubbed and answer the minor only. Only if it is from special skill, it has to be done. Whatever is additionally accrued from that will not be attracted to special talent skill. It is separately taxed. So that's the questions that I've got so far, and some cross transfer. We'll go to that example of cross transfer. We said 6 lakh has been transferred from brother to brother's wife, and this brother has gifted 5 lakhs. So the lower amount is 5 lakhs. So what will be clubbed only is that 5 lakhs proportion. So 5 lakhs, 9% for 8-month interest. So when you're saying clubbing, equal amount, both are equally transferred only. The cross transfer is only 5 lakhs because the extra 1 lakh has to be ignored. So the 5 lakhs for the proportion of 8 months has to be considered. So 5 lakhs into 9% into 8 by 12 will be the income, because 5 lakh is the equal amount that you can take from both these transfers. So that alone is clubbed. The 6 lakh, the additional 1 lakh is actually ignored. So yeah, we'll move on to multiple choice questions. So basically, Arun has sold 7,000, 14% debentures to his wife for 1,75,000. What will be the interest income to be included in the total income of Mr. Varun? So it's basically, let's say 7 lakh is the total investment. So into 14%, but he has already received 1,75,000. So that is her own income. So that is their own, right? So what will be clubbed? Only the difference. That is 5,25,000 into 14% only will be clubbed. So what will be clubbed is the 14% on 5,25,000 only will be clubbed. Kumar gives 10 lakhs to his wife. She invested the same in a firm, K & Co, which she is a partner. Mrs. Kumar receives 1 lakh as share of profit from such firms. What will be the amount clubbed? So when we say investment is made, the proportionate income, it doesn't say that wife has invested something. Wife has invested only 10 lakhs. The entire investment is only from Kumar. So the entire income has to be clubbed. But entire income has to be clubbed in the hands of Kumar. But what is the thing? Partnership. Share of profit is exempt. Share of profit is exempt under 10(2)(a). So this says share of profit is exempt. So though 1 lakh is actually clubbed in the hands of Kumar, it is actually an exempt income. So it is exempt in the hands of Kumar also. So that's what it is. Because the purpose of transfer is to evade tax. When it's partnership firm, irrespective of whether he is a partner or his spouse is a partner, it is still exempt in the hands of both of them. So it is nil. When you club an income under section 64, it will be clubbed under. So what did we say? We said it has to be clubbed in the what head of income? We said income can be clubbed. When I say income can be clubbed, when you are clubbing under what head? Will it be classified as income from other sources, capital gain, business or profession, or the same head in which it is taxable? So yes, the answer is correct. So it is D. So it is relevant head under which income belongs to. The next question, Ankit transferred 1 lakh to his daughter-in-law in 2019 without any consideration. That he has just given 1 lakh. She received 12,000 interest on the amount during this previous year. So what will be the tax treatment? He has given 1 lakh. That 1 lakh has been deposited. So what will be the treatment? Clubbing. So he has given for the benefit of daughter-in-law. So what will be the answer? Whether 12 lakh will be taxable in the hands of daughter-in-law, or 12,000 in the hands of Ankit, or 6,000. So it will be the entire 12,000 will be clubbed in the hands of Ankit. So the next question, Shreya transfers 1,000 debentures of 100 each carrying 16% interest to Rahul on the condition that he will have the right to receive. 4% interest till his lifetime. So what happens here? Till his lifetime. So when you say it is for the lifetime, it is typically like an irrevocable transfer. But what is happening here? He is actually also asking for a right to receive 4% interest. So what did we call this? Benefit. So if there is some benefit coming back on irrevocable transfer, though it is irrevocable, what will be treated? What will it become? It will become revocable. So in this case, it has to be clubbed. So irrevocable transfer. So I always say this, there are 3 ways to answer a multiple choice questions. One is, you know the right answer. You know which one is correct, A, B, C, or D. Another one is, you leave out one by one. You say that it is A is not the answer, B is not the answer, and then identify the correct answer. The third one is by choice. You just pick one using some random rhyme or whatever. So now, what is advisable is, you know what the answer is. So that is a preferred choice. If not, probably you can have this elimination process, rule out one by one and finally identify, but never have a position whereby you are trying to choose by some random choices. So never do that. So that is one of the important thing in examination. So know what you're picking. So in this case, we said this right to receive 4% interest, whatever we are talking about, is basically that taxable, since there is a coming back. So though it is irrevocable, it automatically becomes revocable. So this will be 16,000. The entire thing will be taxable in the hands of Shreya because it has become a revocable transfer. Moment it is a revocable transfer, the whole income will become taxable. We saw an example 8,000, 2,000 in our earlier case. So same example here, the entire 16,000 will be taxable in the hands of Shreya. So we'll just skip this problem. Probably I'll share it. You can work out later, both these problems. So we'll move on to aggregation, the income from carry forward losses. So we'll move on to this. So the next chapter is carry forward losses. So what do you mean by set off and carry forward losses? So typically you have 5 heads of income, right? So you have salary, house property, PGBP, capital gain, and income from other sources. Now, in this case, you can never have a loss in salary. So probably when you're talking about losses, you can leave out salary. But in every other case, there is a possibility that you might have a loss here and there. So typically, we'll have to understand how does this set off work off. If you have an income in one head, loss in other head, all these things is what we are going to discuss. And what happens if you have excess losses that you do not have income to adjust in that year, you carry forward to the subsequent year. So what is the process? So this is what we are going to discuss in this particular section. So in this session, what we are going to discuss is, in set off carry forward, we are going to discuss about 3 broad categories. The first category of adjustment of losses is called as inter-source. What do you mean by inter-source? Within the same source. For example, you have 2 house properties. The first one is a loss. The second one is an income. What do? You adjust them. So that is called inter-source. The next category is called inter-head. What do you mean by inter-head? You have profit and salary. That is, you have income and salary. You have a loss in house property. You adjust both. This is called inter-head. That is between different heads. So this is discussed separately, the inter-head. And finally, we are going to understand what happens when you carry forward. What happens when you carry forward to the subsequent years? What are the process? What is the limits for carrying forward a loss? So these are the 3 things that we'll understand. Whether a particular income is eligible for inter-source, whether a particular income is eligible for inter-head, whether a particular income carried forward if you do not have losses. So we are going to discuss about eligibility of losses under these 3 categories. So this is what we are going to see in this particular session. So this is a summary. We are going to see only this in detail. So whatever we are discussing here, that is, if it's a house property loss, it can be adjusted with all these sets, with any of the incomes. There is no restriction on adjusting a loss from house property. If you have a business or profession, S stands for speculative. If you have a speculative business loss, you can only adjust with a speculative business profit. If you have 35AD is specified business. So that is 35AD. So 35AD is a specified business. So if you have loss from such business, it can only be adjusted with 35AD. Any other business loss can be adjusted with any head other than salary. So, but for salary, it can be adjusted with everything else. The red indicates the red tick indicates inter-source, and the black indicates inter-head. So, PGBP, if it's a regular business profit, it can be adjusted with any heads, but for salary. And if you have a short-term capital loss, it can be adjusted with both short-term and long-term. But if you have a long-term capital loss, it can be adjusted only with long-term capital gain. If you have a loss from horse race, it can only be adjusted with profits from horse race. Any other loss from income from other sources, it can be adjusted with your salary, house property, PGBP, and IFO. So these are the things in which you can basically adjust. So these are the possible scenarios. We are going to discuss this only in detail. So this one slide will give you a complete understanding for your examination, and also what we are going to cover in this. This one slide will give you a complete understanding of what set off and carry forward losses support. Anyways, we'll see that in detail in what the provision speaks about it. So section 70 talks about what are admissible inter-source losses. So basically, loss from one source can be adjusted from any other source of the same head. When you say there is a net income of the head, that is, there is a self-occupied property. You would have studied income from house property. The self-occupied property, if you have an housing loan, whatever the loan will be claimed as losses, right? Restricted to 2 lakhs. So that loss, and you have a rented property where you have an income. This both can be adjusted, right? Can be set off. So can be set off. So this is called inter-source, right? So this is admissible. But loss from exempt source cannot be set off against taxable source. For example, share of loss from partnership firm is technically a business income, but being exempt, it cannot be adjusted. Similarly, loss from agriculture is actually IFOs. It's an income from other sources, but just because it is exempt, you cannot adjust this loss with the income. So that is what it is. So basically, an exempt loss, exempt, or you can call section 10. Section 10 losses is not available for set off. So because it is an exempt source, you cannot adjust it with the taxable source. So that's the reason why it is not allowed. So that is about inter-source. And then you have what is inadmissible. So we are going to see some of the inter-source, which is actually not admissible. So when we say inter-source, if you actually take long-term capital loss, in our first table, we understood short-term capital loss can be adjusted with long-term capital gain, but long-term capital loss cannot be adjusted with short-term capital gain. So that's what is there. So short-term capital loss is allowed, whereas long-term is allowed only with long-term. So that is what is there. So this is the reason which is discussed in section 70, subsection 3, which says long-term capital loss cannot be adjusted with any other losses other than long-term capital gain. So though inter-source is admissible, this section, this slide which we are discussing does not allow inter-source. What did we say for speculation business? Speculation business loss can only be adjusted with speculation income, but other business losses can be adjusted with speculation income also. Same way, race sources. Whatever losses you are obtaining from race sources from owning and maintaining can only be claimed from owning and maintaining race sources. Loss from specified businesses. So 73A says if you have a loss from specified business, you can only adjust it with the business under section 35AD. But if a regular business loss can be adjusted with your specified business. So these are the restrictions on inter-source. That is what is not allowed. Though inter-source is allowed, a specified speculative business can only be adjusted with speculative business. A 35AD business can only be adjusted with 35AD business, right? So these are, though there are inter-source, it is not allowed outside. So that is what is being discussed in this section. So what are the heads that are not available for inter-source? Long-term capital loss, speculative business loss, specified business loss, that is 35AD business loss, race sources, and then finally, these four heads are not allowed to be set off against other source also, other source of income of the same head also. Clear? So that is about inter-source. So what is inter-head? So we are going to see one at a time. The first one is, what about PGBP? It cannot be adjusted against salary. Inter-head is allowed, but loss from PGBP is not allowed against salaries. Loss under capital gain cannot be set off against any other head. So if there is a loss from capital gain, it can only be adjusted with the capital gain and nothing else. So capital loss cannot be adjusted with anything else. Loss under that house property, it can be adjusted with every head, but only a maximum of 2 lakhs. It cannot go beyond 2 lakhs. So that's the reason why there is a limitation. Loss from house property can be adjusted across the platform, across every head, but maximum is 2 lakhs. Anything above 2 lakhs needs to be carried forward. Same way, speculation loss, 35AD loss, racehorse loss is not allowed any other head. Only under that same source, same head. It cannot go beyond that. And the loss head other than capital gain, loss under head other than capital gain can be set off with any other head, including capital gain. So if there is anything else, if other than this, whatever we are talking about, other than the capital gain, if there is any other overall loss, it can be adjusted. So you can go back to the table and just see what we are trying. So whatever we explained in the previous slide and this slide is all that is available in that table. So that table will help you in understanding this provision in detail. So we'll just understand the problem. There is Mr. A. He has 4 lakhs, 70,000 and let out is 1,50,000. So what happens? Your house property. So we'll just keep salary. Salary is what? 4 lakhs. House property. This put together is loss of 2,20,000. But how much is allowed? How much is allowed? Only 2 lakh is allowed. Only 2 lakh is allowed. And then your business loss. Business loss is 1 lakh. Interest is 80,000. Now this two can be set off. So your net salary after adjustment will be 2 lakhs. Similarly, your interest can be adjusted with business loss. So now here your interest will become 20,000. So 2,20,000 will be your income. What happens? Your house property loss of how much? 20,000, and business loss of 20,000 will be carried forward from this particular year. So that is how this question goes out. So the next one is, we'll see the next section that is specifically discussed about house property. 71B, we said the maximum set off that is allowed is only 2 lakhs. Unabsorbed housing property loss can be set off only against house property income. So we'll just understand this. Any carried forward loss can be adjusted only with that head. It cannot be adjusted with anything else. So unabsorbed housing property loss can only be adjusted against house property income. That is carry forward. Can be carried forward for 8 years, immediately succeeding the year of loss. It can be carried for 8 previous years, succeeding previous years. So if you wanted to take an example, let's take salary is 10 lakhs, whereas your house property is actually 2.5 lakhs, but your total income will be 8 lakhs because you can only adjust up to 2 lakhs. The balance 50,000 will be carried forward. So this is an example how you restrict it to 2 lakhs. So that's the relating to house property. The next one is business loss. The loss that may be carried forward and set off against PGBP. So whatever loss that we are talking about can be carried forward and set off against PGBP. So when we said PGBP, it's regular business. So your normal business loss can be set off with every heads except salary. So other than that, it can be there. So what are the basic conditions? The first 3 conditions are related to what you are doing. So we can call it as activity. So it should have been incurred by happening that business, profession, or occasion. So there must be a loss from such business. The loss should not be in the nature of speculation, because if it's speculation, it can be adjusted only with speculation. If the loss is speculation, it can be adjusted only with speculation, and need not be necessarily adjusted in the same business. So the point here is, if you have one business as hotel business, another business as let's take movie industry, movie business. Now, movie loss can be adjusted with hotel profits. Both can be adjusted. Hotel loss can be adjusted movie business. So what we are talking is not the same business. It must be the business of the associate. That's what it is about. So adjusted against the same business or profession is not a condition, need not be necessarily adjusted. The next two is about succession, that is, let's say, person oriented. So the first one is whoever is actually claiming the losses, he only should carry forward. If it is for a company, only the company can adjust. If it is an individual, only that individual can carry forward the loss and adjust. So it must be the same person. It must be the same person. It cannot be a different person. But in some cases, that is, you call it a successor of business. Generally, successor cannot carry over the loss, but for inheritance, that is by will or some legal changes, that is mergers, acquisition. So if there is succession by law or inheritance, such successor can carry forward the losses. Otherwise, there is no provision for carry forward. So successor of business cannot carry forward unless it is by inheritance or by law. And this is period. So in conditions, we are doing it three bases. That is about the nature of business, that is the activity of the business, and then the person who can carry forward. And finally, we're understanding the period of carry forward. So period is basically 8 years succeeding. And when it comes to unabsorbed depreciation, there is no year. What is unabsorbed depreciation? Generally, let's take an example. Your total business loss is 20 lakhs. Let's say your depreciation is actually 15 lakhs, right? So this means your loss out of 20 lakhs is because of this 15 lakhs also. So if this depreciation has not been there, probably you would have made only 5 lakhs loss. So this becomes unabsorbed. This becomes, that is balance. 20 minus 15, 5 becomes business loss. So this can be carried for 8 years. And for this, no limit. It is indefinite. So it can be carried forward for the period of indefinite years. So unabsorbed depreciation, it is indefinite period, whereas your regular business loss is only for a period of 8 years. So we'll see this example. Income from salary computed. Income from salary is computed at 45,000. House property is 24,000. So you can adjust this. So you get 21,000, correct? And then income from non-speculative business is basically 22,000. Income from speculative business is 4,000. Short-term capital loss is 25,000. Long-term capital gain is 19,000. Short-term capital loss can be adjusted with long-term capital loss. So you net off, this becomes nil. So what all gets carried forward? This 22,000 gets carried forward. 4,000 gets carried forward. 6,000 gets carried forward. So all this gets carried forward for the future years. So this is what is about. So the business loss, the 22,000 will get carried forward for 8 years. The 4,000 will also get carried forward. So this is what is about set off. Now we've been talking about the word speculation, right? What is speculation? We need to understand to differentiate between speculation business and regular business. So basically, losses incurred can neither be set off in the same year or against any other non-speculation income or carried forward in the subsequent year. So typically, whatever we said speculation loss can be adjusted only with speculation gain, not with any other source, not with any other head, not with any other source, not with any other head. Loss from speculation business can be carried forward for a minimum period of 4 years. Your regular business, we said 8 years. Here we are only saying 4 years. It is only 4 years. But what is actually speculation is what we are trying to understand, right? So basically, speculation is what involves certain amount of uncertainty. Nothing is certain. Probably like your, it's like you're betting, gambling. All these things are called as speculative. So the result is not certain. So that's what it's about. But certain things, though the results are not certain, have been specifically held as not speculation. That is hedging. Hedging is basically for foreign currencies where you try to minimize the loss of your foreign currency loss. So let's not go into the detail. we'll just understand it as hedging. And similarly, forward contract. So forward contract is also again related to your shares, where there are called as futures and options. So in that case, trading in forward contract, trading in derivatives, all these things related to the share markets are also not called as hedging. The principal business, the next category is, if your principal business is trading in shares, banking or granting of loans and advances, then anything related to this shares, which could be called as speculative, will also not be speculative in nature. So typically, things like your intraday, you call it as intraday trading. That is one of the main category of speculation. Is in case of share market is, there is no delivery of shares. No delivery. Typically, when you buy a share, you become a owner, right? So in certain cases, you actually don't own the share, but you deal in that share. So probably you buy it in the same day, sell it in the same day. So this intraday or something is basically called as your speculative income. But if your business itself is trading in shares, that will also become non-speculative. So if your business itself is banking, then also it becomes non-speculative. Your business is granting loans and advances, these transactions will not be called as a speculative transaction. So this is what you're calling as, if you're in these three these businesses will not be called as speculative. Similarly, if your gross total income is primarily interest on securities, house property, that is, you don't have business or profession, you only have these sets of income, then also there is no speculative, because only in business you have this classification between speculative and non-speculative. So if you don't have business income, what you have is only other heads of income. We are not going to talk about the word speculation itself. So this is what is discussed here. So basically, if it's a speculative business, it can be only carried forward for 4 years. As per a specified business, it falls under section 35 AD, which is investment linked. Investment linked deduction. So for that, it is basically same year against or any other. So it can only be set off with the loss from investment linked business, can only be set off with profit from investment link. So that is what specified business is about. And it can be carried forward and set off indefinitely. So there is no limit for this. It can be set off indefinitely. So there is no limit for this. Can be business. So let's say you have two specified businesses. One is hotel, another is hospital. You can inter-adjust. So there's nothing wrong. You can set off between another specified business. So only thing is, you cannot set off with a business which is not specified. So that's the only category. So that is about specified business. Probably if you wanted me to explain you why this alone is indefinitely and not for other businesses, this business has deductions 100% of even your capital expenditure. So in some cases of this investment linked deductions, you are eligible for 100% of your capital expenditure. So imagine the quantum of the loss that you'll be accumulating when you're actually claiming 100%. It's like claiming 100% depreciation, right? So what is it for depreciation? Unabsorbed depreciation. How many years it can be carried forward? Indefinite period, correct? Same applies here. So this loss, whichever we are talking about, would have been primarily for this capital expenditure only, because that is the provision about investment linked provision is all about your capital expenditures. So when you talk about capital expenditure, the deduction that you're getting is similar to depreciation. So what is the procedure for depreciation? You can carry it forward for n number of years. So same applies here. So that is the reason why this is indefinitely. When you're understanding the provision, understand the reason why that provision exists, rather than just trying to remember the provision as it is. So that's the point here for this provision. So it can be carried forward indefinitely. So for capital gain, we have already discussed short-term capital loss can be adjusted with long-term capital gain, but long-term capital loss cannot be adjusted with short-term capital gain. And as we said, this long-term capital gain, that is long-term capital under 112A, can also be adjusted. So there is no restriction between long-term capital gains. So loss under 112A can also be adjusted under gain under section 112. So whatever is any unabsorbed loss can be carried forward for a maximum of 8 years. So this is also 8 years. The common period is 8 years, but for your speculation business and horse race, where it will be 4 years. So short-term capital gain on sale of shares is 1,50,000. Long-term capital loss is 9,60,000 from previous year. Short-term capital loss is 37,000. So this is also previous year. So now you can adjust these two. That is 1,50,000 and 37,000. So the balance, that is 1,13,000, will be the short-term capital gain that is taxable. For long-term capital gain, you can adjust these two. So for this, it will be what? The entire 75,000 will be adjusted, and the balance, that is 21,000, will be carried forward, right? Will be carried forward. So that will be the impact of this particular sum. Next one is horse races. So what is related to horse races? Loss incurred in owning and running can be only adjusted with that, and it can be carried forward only for a period of 4 years. So we'll see another exercise problem. Income from the activity of owning and maintaining the horse races is 75,000. And he already has a brought forward loss relating to assessment in 1920, that is 96,000. So this can be completely set off. So this will become nil, right? Can be carried forward for 4 years. If it is relating to assessment in 1920, 2021, 21, 22, 22, 23, 23, 24. It can be carried forward till the next year. So being 22, 23, we can adjust this as nil. Income from textile business is 85. And profit loss carried over from a textile business can be adjusted. So it will become 35,000. So this is the adjustment that you'll be making it here, right? So this is the thing. Okay, I'll answer some of the questions before I move on to the next thing. Speculation loss. As I told you, speculation loss is basically, Chaitanya, the speculation loss is typically preferably in your share market or something where you have this intraday trading, where you don't buy the shares, you don't hold the shares. So in the share register, your name will not apply at all. You'll buy it on the same day, you'll sell it on the same day. So this intraday trading is typically called as speculative, or any other business which involves betting, gambling, or something of that kind, speculative, where the result is uncertain. The result is uncertain. So that is what is called as speculation loss. Dubey, why the loss is limited to 2 lakh only? Because housing property, the loss will be restricted only to 2 lakhs. What can be adjusted to the other rates can only be up to 2 lakhs. The rest only will be carried forward. With relevant to inter-source and inter-head adjustment, in the first year of loss, inter-head is allowed. In the first year of loss, inter-head is allowed. In the subsequent year, inter-head is not allowed. You can only adjust it in the same head of income. So that's the point. So in the first, you adjust it within the source. We'll see that, okay, what are the order in which the losses can be adjusted. But typically, to understand, the first preference is inter-source, then inter-head, right? And whatever is carried forward, the only option is inter-head, because no inter-source for carried forward losses. So that's the point here. Same head or under same head. Okay, for unabsorbed depreciation, Dubey, what we are trying to say is, we just explained, what we are trying to say is the business loss is after providing depreciation. So if depreciation was 15 lakhs, your total business loss is 20 lakhs. You're trying to break up the loss. You're trying to split the loss into what is because of the business, what is because of the depreciation. So in our case, the total loss was 20 lakhs, but your depreciation was only 15 lakhs. Depreciation is 15 lakhs, which means out of 20 lakhs, the reason for your loss is purely because of depreciation. 15 lakh is because of depreciation. That is called unabsorbed depreciation. So to the extent your loss is because of depreciation, that becomes unabsorbed. The rest will be called as a business loss. And what about carry forward after 4 years, 8 years? Sandeep, after the year, it lapses. So which means you are not eligible to set off those losses. So after the 4th year and 8th year, you cannot adjust it. Whether unabsorbed, Shibin, unabsorbed depreciation can be carried forward for n number of years. There is no limit at all. So how many years you want, you can carry it over. Whether short-term capital loss can be set off against long-term capital gain. Short-term capital loss under section 111A, Rogan, whatever short-term capital loss can be adjusted with long-term capital gain. There is no restriction. So any short-term capital loss can be adjusted with long-term capital gain. Yeah, so I'll just go back to the slide. We'll just see the order in which your questions, in which your losses can be carried forward. So first preference is current year depreciation, okay? So the first preference is always with the current year depreciation. So you have to provide your current year depreciation, only the balance has to be considered losses. And next is current year capital expenditure on scientific research. That's the second preference. So that's the order in which you'll have to set off. The third one is you will have to take whatever is a brought forward loss of business or profession and adjust it with your thing. And the fourth is unabsorbed depreciation. Fifth is unabsorbed capital expenditure. Sixth is unabsorbed capital. So this is typically for your PGBP. In business or profession, the order of setting of losses is first is current year. Current year depreciation, current year capital expenditure on scientific research and family planning. Then you take brought forward losses from the earlier year, and then you take unabsorbed category, unabsorbed depreciation, capital, the scientific research, and your family planning. So this is the order. So first is current year depreciation, capital, and these are the rest of the things. So this is the order in which you'll have to set off profit and gains from business or profession. And you cannot carry forward. You cannot carry forward unless the return has been filed on time. This is discussed in section 80. So what are the losses that cannot be carried forward unless return is filed? First is business loss cannot be carried forward unless you file your return on time. Speculation loss cannot be carried forward. Specified business cannot be carried forward. Capital gain cannot be carried forward. Horse races cannot be carried forward. For all these things, you must file your return on time before the due date specified under section 139. What is 139? We'll definitely cover in the subsequent classes. In the subsequent sessions, we'll be covering about return filing. So you'll have to file it within the due date. Due date for filing a return of income, only then you're eligible. So this does not apply for house property loss under section 71B. So which means house property loss can be carried forward even if you're filing belated return. So even if you're filing belated return, both this housing property loss and unabsorbed depreciation can be carried forward. So this is a recap of the entire thing that we were discussing. So one thing that will not be here is about depreciation. Everything else will be here about. So housing property loss can be adjusted with every head of income, but subject to maximum of 2 lakhs. 2 lakhs is the maximum. So 2 lakhs is the maximum thing eligible. Specified business can only be adjusted with specified. 35AD only with 35AD. Regular business, but for salary, it can be adjusted with everything. Short-term capital loss with both short-term and long-term. Long-term capital loss only with long-term. Horse race only with horse race. So these are the categories of your loss adjustments. So everything else is what we have discussed. And what about the period? House property can be carried for 8 years. Speculative is 4 years. However, even in speculative, if it is related to depreciation, your scientific research and family planning, there is no limitation. So specified business, that is 35AD, there is no limit. We said the reason why there is no limit for this. Any other business, it is 8 years. Short-term capital in 8 years, long-term capital in 8 years, horse race 4 years. Once carried forward, it can always be set off only under the same head. It cannot be taken with the rest of the heads. For the balance 4 years or 8 years or whatever you have, it can be adjusted only with the same head of income. So Surat is in business of textiles. They have a suffered loss from transactions, from what? Sale and purchase of shares. So the share trading is typically whatever, if it is speculative in nature, this share trading is whatever from the profit of textile business cannot be adjusted because share trading will be considered speculative, whereas profit of textile business is not speculative. But if they are actually in the business of shares trading only, then everything becomes a regular business. So there is no issue at all. So otherwise, speculative loss cannot be adjusted with non-speculative, that is regular business loss. It is about a partner's death. So what happens is once a partner, it's not even a death. It's basically partnership was dissolved and individual partnership was carried over. So now ST and Co is becoming, let's say, S and Co. So this is from firm to individual proprietor business. So we said any conversion, only the person has to carry forward. So to the extent of loss eligible for S, he cannot carry forward because it is from the firm to proprietor business. So he cannot carry over the business because this is not succession or inheritance, succession by inheritance or law. So this cannot be carried forward. But in case if it is a case of inheritance, then it can be carried forward. So only in the case of inheritance, it can be carried forward. So the assessee claimed the set of losses, partnership firm against his income earned as individual property, considering the case as inheritance. Is this inheritance? No, it is not inheritance. So because inheritance is basically from mergers, amalgamation, and probably one legacy to legacy, father to son and other things is only inheritance. So this is not inheritance. So you can see this business later, and also the MCQs. So we have some MCQs. Probably I'll put the slide in your portal so that you can work on these exercise problems alone. So that is what we have from this particular session. So we'll continue with the next session with respect to topic on deductions on chapter 6A. We'll have next 2 sessions on chapter 6A deductions. So thank you for the session.
Recording stopped.